Thanks for joining us, of course, joining us there from London. Let's just take a look at the latest issuances, and I suppose really indicating the increased demand for fixed income assets from international investors. You had Namibia with 5 times oversubscribed Eurobond there, and then, of course, Zambia was a big standout, 20 times oversubscription for that Eurobond. Your thoughts on the demand that we've seen so far this year and the kind of demand that is coming through from international investors for African debt?
Good morning, Samantha. Yes, of course, when we look at the 2 latest issuances from 2 sovereign countries in Africa, you name it, Namibia last year in September and Zambia last month, they were extremely oversubscribed. The order book for Namibia was 2.5 billion for 500 million bond, and it was $12 billion for a bond of 750 million asked by the Zambian government. When you look at this number, you think that probably it's linked to the liquidity on the market, the unorthodox policies by central bank, the quantitative easing, also the portfolio reallocation from international investor, and the search for yield, higher yield from investor, and portfolio reallocation. But we think at Moody's that there is also a good story in Africa. Zambia is part of this story, of a sustainable growth story, and in fact, investor wants to be part of that story, and this is why the book was so high.
But if you put it into context, I suppose it's always good to do that. If you look at Africa versus Asia Pacific, and if you look at Africa versus Latin America, overall debt as a percentage of GDP is still very small. I mean, you've got to exclude South Africa because South Africa, a completely different story to the rest of sub-Saharan Africa with a very well-developed debt market. But I mean, debt security to GDP sitting at 1.3% over the last decade. And you're looking at that a percentage a lot smaller than other emerging markets. Why is that?
You're perfectly right, Samantha. In fact, when you take everything into account, the whole stock of debt outstanding on the international market from financial institutions, sovereign and corporate is roughly $70 billion at the end of 2011. It's very small compared to Latin America or Asia, which are in excess of 500 billion. And on that amount, you have also to take into account the growth rate of this issuance of debt securities. Between the last 10 years, 2001 and 2011, the stock of debt securities coming from Africa has tripled. And the growth rate, according to us, is going to continue over the medium term because, as you mentioned, the infrastructure needs, and we explained that are estimated to 90 billion a year in Africa. And so, of course, there will be foreign direct investment, worker remittances, bank finances, capital flows, portfolio flows. But more importantly, there will be also the part given by the sovereign, because they have a bit more of fiscal space after all the initiative for debt reduction. And we see the issuance of sovereign as the opener, as sovereign first, and then corporate banks will follow through. One thing to also take into account is that the sovereign have different ways to finance themselves. They could go into multilateral financing or bilateral financing. In Africa, it represents more than 75% of the external debt of government. Yeah. But the issuance of international bonds is only 10% of the stock.
Yeah, I mean, I'm sure, you know, for a ratings agency like yourself, this puts increased pressure on you if there's more demand for ratings on credit worthiness or foreign currency ratings. You'd perhaps have to be positioning yourself to have increased coverage of these sub-Saharan African countries.
Of course, I think when you take a step back and you look at the coverage that exists on Africa, only 30 countries out of 54 are currently rated. Some financial institutions and few corporates, it's really small in fact, and we expect as the continent will be more and more integrated with the rest of the world through trade and also with the financial market, this ratio should increase massively because the countries and the continent needs to access external long-term finance at a relatively low price, especially compared to domestic costs because of macroeconomic volatility in some countries. The possibility to tap international market will be favorable, and so there is a potential for an increase in rating coverage of the continent.
I suppose where there's demand, the market will adjust for it. Thank you so much for joining us, Aurelien Mali, Senior Analyst at Moody's.